Whether it's learning about earnings estimates, exploring the Zacks rank, or adding to your financial toolkit, get the education and resources to help you become a more successful investor here on Investing the Zacks Way. Steve Reitmeister, our editor-at-large at Zacks.com, recently did a segment about how the Zacks rank works well with the four main investing styles. You may recall that. Well, today he's joined by Bill Wilton, our aggressive growth stock analyst for Zacks.com, to talk about, you guessed it, how to pick aggressive growth stocks the Zacks way. Welcome to both Steve Reitmeister and Bill Wilton. Great to have you both here. Let's get right to it. Bill, let's start with you.
Okay.
Let's go over how you would differentiate, if you would, aggressive growth investing from all of the other styles.
Well, it's all in the name. Aggressive growth, you're looking for, obviously, large growth rates. You're looking for 20, 30, even 40% on an annualized basis. It's more of future potential than any of the others, any of the other investing styles. You look at momentum, relies a lot on what's been happening recently. Value is looking at those very cheap valuations. Growth and income, obviously looking for those dividends, your more stable companies.
Right.
These aggressive growth stocks tend to be small to mid-cap companies with a really sexy story. Everyone wants to find the next Google, the next Microsoft that's really going to take off. So quite a bit different than the other styles.
Sex even plays a role in investing these days.
Absolutely.
So, Steve, what is the benefit then of using the Zacks rank and earnings estimates, which we have talked about so much here, to bolster aggressive growth stock picking?
Yeah, aggressive growth is all about future earnings, okay, and the growth of these companies. The Zacks rank is all about future earnings, okay, and earnings estimates. And so really it's two peas in a pod. They work so well together. Whether that be using the Zacks rank to find the best aggressive growth stocks to invest in, so narrowing down the list, or whether that be knowing which ones to hold and which ones to sell. Because one of the problems with aggressive growth stocks is when they fall, they really tumble. And so you definitely want to get that clear signal when to get out, take your profits, and move on. So we'll kind of go over both of those today.
All right. I want to go back to Bill for a moment. Bill, would you tell us about the key ingredients that investors should then look for when they're trying to find the best aggressive growth stocks? And also, if you could point out for us the potential pitfalls to avoid, because I'm sure there are some.
Absolutely. Well, like we said earlier, you're starting off with those growth rates. But the tricky part is there's over 500 companies that are projecting more than 20% growth over the next few years. So from there, you want to add the Zacks rank that Steve talked to you guys about. Once you put a 1 or a 2 ranking into that criteria, you're looking at nearly 150 companies.
Okay.
So that boils it down to a manageable number. From there, you're looking for top-line growth. You want to make sure that this is a sustainable business model that's not just going to be a flash in the pan. It's going to be there for years to come. You're also looking toward the PEG ratio. While aggressive growth does look for, like we said earlier, the sexy story, you don't want to ignore value. Make sure you're not overpaying for these growth prospects. Ideally, that PEG ratio is going to be near 1.0, but you always want to compare it to its competition within the industry.
Okay.
As far as things to avoid, sticking with PEG ratio, you don't want too cheap of a PEG ratio because that's kind of a red flag. Why is this growth rate so cheap? Do people know that these things aren't going to be there in the future? Also you're looking for sustainable growth rates. You want to make sure that these earnings are going up, not because of things like cost cutting, which is a one-time measure that a company can deploy. You want to make sure that they're taking active management steps to build the business, not just cut costs.
All right. That sounds like some sound advice. We got them all in?
Well, there's just a couple quick things that you also want to be cautious about. Could be good, could be bad. Things like stock buybacks. A lot of people feel that's a very bullish signal because you're obviously taking away some of the outstanding shares, puts more earnings into the pockets of the current shareholders. But as far as aggressive growth companies go, you want to make sure that they're doing that with the investors in mind and not because they don't have any other projects to invest that cash into. So as a growth company, they should be spending their resources growing the company. So that's one thing you want to make sure that you're looking for. Also things like acquisitions. making sure that they're not just buying up companies that have high growth rates to artificially inflate theirs. That's going to be a temporary measure, kind of like cutting costs.
Right.
The last one's going to be expansion. If you're expanding rapidly, that's not going to be something that you're going to be able to keep up forever and ever. So you want to make sure that the expansion that they're going through, opening up new stores, new services, new products, is something that they're going to be able to do for the foreseeable future.
Okay. So then once an investor buys one of these aggressive growth stocks, Steve, and I'll underscore buys,
Okay.
What's the best way to know when to sell them?
Right. Well, as I was trying to allude to earlier, it's all about the future earnings growth potential. And what happens is that investors, these are the sexy stories. These are the stories, here again, the future Googles and the future Apples. And a lot of people will jump on board these stocks because what they're going to do is they're going to have quarter after quarter, they're just pounding out earnings surprises, and it catches a lot of investor attention. And so more and more people get in there. The stock price goes up, and the PE starts to get expanded. So we call that like premium. So some premium is being put in the stock. So for a period of time, they can keep up the premium because they are growing at such a phenomenal rate. But it never lasts. Whether that's a couple years down the road or 5 years down the road, at some time, they can't hold up under the pressure of all the earnings expectations. You just can't keep growing for 40%, to the end of time. And so once those earnings expectations for the future start slowing down, and here again, it's not about having a loss. It's about when you go from 40% growth down to 30 or 25 or 20, the PE has to come down and the share price is going to come way down. And so earnings estimates and the Zacks rank is going to help point that out. So we've got two examples we want to show folks quickly here of how they can look for those kind of indications.
Okay.
So the first one we're going to take a look at here is Faro Technologies. This is the pricing consensus chart that's available for free on Zacks.com. I've circled here the first point, which is in the spring of 2006. We see that the earnings estimates are starting to go up. I should point out the dark black line, that's price movement, and the multiple colored lines, those are the movement of earnings estimates for the different years. So as you can see here, that the earnings estimates are starting to go up. Not surprising, the share price going up. You could have bought this around $12 to $15 back in the spring of 2006. Now take a look how the earnings estimates keep going up, and not by a little bit, by a lot. This company is just blowing away earnings numbers. Estimates are going higher, and the stock gets all the way up into the high 40s about a year and a half later. Now we're not saying we're always going to get you out right at the peak. But you'll notice right after the peak, and I have it circled there, the earnings estimates start to head lower. That pinkish, reddish line there starts to head lower. I'm saying you could have probably got out around $40 per share. Okay, so riding it from about $12.15 up to $40. Now, what happens when we don't heed those lowering earnings estimates? There's usually more pain in the future, and you'll see how that stock continued to fall and fall and fall. And now it's actually trading for about where we would have bought it originally. I'm going to show you a very similar story with Tetra Technologies. If we go back here, back to 2005, we'll see a nice period that I circled there where earnings estimates are going up. We could have bought this stock around $10 per share. Up, 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 and up. Okay, here again, not trying to say that we always sell at the peak, but take a look at that second circle where I'm showing that that estimates line is starting to fall clearly. We could have got out at about $28 per share, which is a big 180% gain. And then, maybe it goes up a little bit afterwards, but look what happens. Once the estimates come down, there's usually more bad news in the offing in the future. And now it's actually trading for less than we would have purchased at. So earnings estimates and the Zacks rank is the best way to take a look at the health of stocks to stay in and ride them up to higher profits, and when to get out before they implode on themselves.
So then what free resources are available from Zacks to help investors find these best aggressive growth stocks that we're talking about?
Well, one of the most obvious ones is the aggressive growth Zacks rank buy. It's in the upper right-hand corner of Zacks.com. Also available in the Profit from the Pros newsletter that goes out. We actually have an entire education center dedicated toward the aggressive growth strategy. PDF files, videos in there, a lot of articles that you can read about aggressive growth investing specifically. And also the portfolio tracker. Like we mentioned earlier, it's very important to monitor those earnings estimates once you do purchase one of those stocks. So what the portfolio tracker allows you to do is easily follow changes in earnings estimates, like Steve talked about. Give you the warning sign when it's time to get out.
And if there are free resources, there must also be paid for resources.
We have some premium resources that kind of build on what Bill is saying. That sounds funny just to say that. For Zacks Premium members, so all of our paid services include membership in Zacks Premium. And so when it comes to finding the stocks, as Bill kind of mentioned, taking a look for growth stocks, there's well over 500 that you could find right now in that range. But here, narrowing that list down. So obviously applying the Zacks rank and narrowing the list down. So using ones and twos or just ones if you want to stay in that best range of stocks, and applying value and perhaps market cap or any other indicators you want, and narrow down that list to find the good stocks. But here again, once you find the stocks, then you want to monitor them. So the free portfolio tracker has earnings estimates, but here again, there's a lot of magic to earnings estimates, and Len Zacks put the time in to kind of merge those things together in the Zacks rank. So it's a lot easier just to take a look, has the Zacks rank changed? Has the Zacks rank fallen to a 4 or a 5, which clearly means sell, as an indication, because sometimes looking at the estimates, it's a little hazy as to how to interpret that. And for the folks who don't want to spend all night studying 50, 100 stocks, because some people do. Some people love doing that. I know a couple guys in the office that they look forward to getting home and doing that all night long. But there's some folks who just rather Zacks do some of the work for them. We have a service called the Zacks Growth Trader, where we have a back-tested formula where we're taking a look at exceptional growth rates and value, and our traders are picking out the individual stocks and giving them to folks about 5 stock picks at a time. And one of the things that we really made sure was in the strategy that it held up well during down markets, and it has held up well. And so that's the Zacks Growth Trader.
All right, thank you very much. And there you have aggressive growth stock picking, the Zacks way, with Steve Reitmeister and Bill Wilton. And with them both, I'm Terry Ruffalo.